What's up, everybody? Joe Brown here. This is the Heresy Financial Show. Right now, with inflation raging, everybody is looking for a way to invest their money to beat inflation. This leads many people to look at gold and silver miners, which I've been talking about a lot recently. One big thing to watch out for, though, is that miners have costs also. And so as inflation takes off, that could negatively impact the profits of gold and silver miners. So I wanted to bring on somebody who knows a little bit about getting around the costs of miners and getting access directly to the top line of these companies, the revenue, not worrying about the rising costs. And so I brought on CEO of Vox Royalty Company, Kyle Floyd. I asked him to come on the channel to talk about this, talk about some of the problems in the space, and talk about some of the ways that his company is able to get around that. And they were kind enough to sponsor this video as well. Kyle, thank you so much for joining us today. Really excited to talk with you.
Joe, my pleasure. Excited to be with you.
All right. Hey, well, we were talking earlier about before we started recording about what is going on with interest rates and gold right now. And it's really counterintuitive to the mainstream way of how things, are supposed to work. Rates are going up right now. If you look at the chart of the 10-year yield, literally looks like a penny stock, just, a hockey stick just going straight up. But we're seeing a lot of strength out of gold. And typically people say, hey, when rates are going up, gold should be going down. That's not happening right now. What are your thoughts on that?
Well, I think investors have to look first and foremost of what is actually driving rates going up. And the reason for rates going up is really one primary reason, that's inflation. And so inflation essentially means your dollar is getting less valuable every single day. And gold and commodities generally are viewed as a very strong inflation hedge and an asset class overall in commodities and gold that do very, very well in inflationary cycles. So those two things, inflation and rates going up, tend to go hand in hand. But the driver, the cause of all of this is inflation. And those two commodities or commodities in general do exceedingly well at inflationary times. So yes, it seems counterintuitive at face value, but what's underlying and driving the scenario where rates are increasing is in fact inflation.
Yeah, that makes a lot of sense. And given all the inflation that we've had, pretty much every single month, we're getting a higher and higher reading. And so given that, everybody is looking at ways to protect themselves from inflation, obviously. And especially viewers on this channel, they're looking at miners a lot, because if something like gold is going to go up from inflation, then you'd expect something like the category of miners to do even better, because typically it's a leveraged bet on the metal itself. So I'd like a brief overview from you on what are the different types of miners out there, because they're not all created equal. They're not all the same types of things. So what are the different categories and what are the differences?
Yeah, absolutely. So really, I'll break it down by stage of development. So there's a huge number of mining companies that are in exploration. And what exploration means is they're looking for the world's next great mineable deposit of all sorts of commodities, but generally hard rock mining assets. And so they're out there doing a lot of very early stage, very difficult work, prospecting, literally turning rocks over. And ultimately, at the end of the day, very capital intensive business. There's no revenue yet. They are out there doing work such as drilling, trenching, sampling, and really trying to understand if there's a strong enough geological anomaly that can become a mine one day. And so that speaks for probably about half the companies that are out there are in that exploration stage. Okay. Then there's development stage. So then there's a group of companies that essentially believe they have an economically mineable deposit, typically reserves denote that. And now they're in the process of trying to grow the amount of resources or ounces or tonnage of mineable metal that's in the ground and go on the pathway to production. And so all the development studies that have to take place, there's called preliminary economic assessments, pre-feasibility studies, bankable feasibility studies, all those lead to de-risking of the asset and higher confidence that that is going to be a successfully mined asset at the end of the day. Then there's the group of large cap miners or mining companies that are in production. And they typically have one producing asset to 20 or 30 producing assets. And they kind of span that entire spectrum. So they will have exploration assets within their portfolio of assets, development stage assets that they expect to be coming online over the coming years, and then major assets that are in production. And so that's kind of the three categories of mining companies. A little bit of an oversimplification, but gives you a pretty good idea of the landscape of mining companies.
Now, given what's going on with inflation right now, you might expect something like GDX, just the standard, approach. If nobody really wants to do the work of picking out the individual miners, GDX, GDXJ, SIL, and SILJ, the main ETFs for gold and silver miners, people are going to look at those and say, they haven't been performing as well as I might expect. And so what's the relationship there? Because given the type of inflation that we have and the persistence and the level, that can actually kind of turn some miners into, kind of like running on a treadmill, right? Where they're making more revenue, but they're also struggling to keep up with the increased cost.
Yeah, Joe, exactly. And I think there's more challenges than what meets the eye. First and foremost, I believe it's Shadow Stats that publishes this data. But if you were to actually look at the same inflation calculations that they used in the 1980s and apply that to what we're experiencing now, inflation would be probably double. I think they quote 15%, but it's likely even more than that. So the inflation rates that we're seeing are heavily manipulated. And I won't get into huge detail on that, but I think it's important for people to realize that the inflation numbers are probably a lot more significant than what they're seeing in these prints. But as a subset of that, there's a lot of different calculations that go into measuring inflation. But if you take this subset of inflation that afflicts mining companies, because mining is a very cost-intensive business, very capital-intensive business, and it has a lot of variable costs and a lot of fixed costs. So the costs that afflict mining companies, think about it, it's diesel, it's electricity if they're lucky enough to be on the grid, it's people costs, it's infrastructure costs. Those are some of the highest inflationary numbers you're seeing in terms of direct input costs. That's afflicting mining companies very, very acutely. So what investors expected to happen was, well, there's a lot of interest in precious metals. There's a lot of interest in commodities. There's a lot of interest in getting exposure to leverage in those prices and those opportunities. The problem is the mining companies are afflicted by the same issue of inflation that we are as consumers. Yeah. So what's happening is their earnings power is getting deteriorated. Yes, the metal prices are increasing, but inflation and the direct inflationary inputs that mining companies have been some of the most affected in terms of cost increases. So there's what investors are looking for and what they're getting is a little bit different. And so the mining companies have not kept up as much as you would have expected in terms of price appreciation coinciding with metal price appreciation.
Sure. Yeah, absolutely. And I'm sure it depends on the company that's chosen as well. And that's why when you look at the broad baskets, you see a little bit more of that muted impact compared to what you might expect. So explain then really briefly, what is a royalty company? How does it work? Where does the revenue come from? And the difference between the two main types out there, royalties and streams.
Yeah. So Joe, I think this is, you can call it an investment hack, if you will. It's just, the royalty model is asymmetrical in terms of upside and lower risk. And the reason for that, first and foremost, royalty companies are diversified. So take a company like Vox, for example. We have 55 royalties and streams. So you no longer have single asset exposure within our portfolio, which at the junior side of the market, you absolutely do. So for a company like Vox, 120 million-ish market cap, you're usually, if it's a junior mining company, single asset risk and a lot of risk that you as an investor aren't going to understand. Secondly, our business model is centered around essentially acquiring top line revenue, percent of revenue interest in these mining operations. So it's not an equity investment. This entitles us usually for the life of the mining operation to a percentage of the revenue it generates. What's really important to understand about that is that's up here, that's top line. So that's based on the revenue, not the profitability, not EBITDA, not operating profit, not net profit. So if the cost of a mining company increase, that does not affect us. What we care about is increases in production, increases in metal prices, and that is a compounding effect for us. But it's that the fact that we're not exposed to those operating costs, and therefore if costs are rising, that does not create a deleterious effect to our earnings power as a business, but we are getting the benefit of rising commodity prices and usually rising production alongside of that. So that's how the royalty model works. And that's one of the key differences is you're getting diversification without equity dilution. So that interest goes on in perpetuity, whether we contribute capital or not, that interest is usually going on in perpetuity without dilution. And it's exposed to all the upside that the miners get. So a lot less risk, and a lot less upside. And it's really hard to calculate the upside. You and I have spoken about this kind of off air. The fact is there's a compounding component to this upside that we're not contributing capital to. So when I said it's asymmetric in terms of both upside and risk, it's very important to understand kind of some of the dimensions of that.
Yeah, and I think this is why it's so important to understand, especially in times when we're experiencing a lot of inflation, and where you're starting to expect that there might be some massive potential for financing in the mining space with a lot of money rushing in, that royalty companies, they're not getting diluted. Their royalties aren't getting diluted by all this capital rushing in. It's so, like, just to summarize what you said, basically, if the mine produces more metal, you get a cut of that. And that cut stays the same regardless of how much money comes into that mine. It's on revenue, it's not on profitability. So regardless of what inflation does, if the mine is producing, you're getting a cut of the revenue.
Exactly. So mines have a high degree of variability in their profit margin. And the great thing about a royalty company is we're not exposed to that variability in the underlying mining company's profitability. And, I'll give you an example of how this kind of works. You'll buy a royalty over a project. For Vox, we buy it at great value for where it stands today. Let's say there's 1 million ounces in the ground of reserves. Well, there's 1 million ounces based on a 1 gram per ton cutoff grade. When the metal prices rise, that lowers the cutoff grade, bringing more ounces into reserves. What does that mean? So let's say there was 2 million ounces, or let's call it 3 million ounces of inferred resource that was not really economic. 1 million ounces was economic and therefore reserves, but there was another 2 million ounces that wasn't. When the price of the metal goes up, the cutoff grade can go down, which means there's more metal to be mined. So now there's 3 million ounces because metal prices since 2014 are up almost 50%. Well, fantastic. What does that mean? Now there's 3 million ounces covered under royalty, multiplied at a higher price for Vox, being the royalty holder. For the mining company, those ounces that come into the mine plan are not as profitable as the ounces that were necessarily in the mine plan when the cutoff grade was higher. So the fact of the matter is that profitability might not be there at the end of the day, but for Vox, we're not exposed to, are those ounces at the end of the day profitable? Because we're getting paid based on the revenue that those ounces generate. And that's a compounding factor. So now 1 million ounces that we were going to get paid a royalty on is 3 million ounces at a higher metal price. And we're not contributing all the capital that's going to take to go from mining a 1 million ounce deposit to mining a 3 million ounce deposit. So that's what happens. And then the mining company is successful. They're incentivized and encouraged to go explore for more resources all around that deposit that might not have been anywhere near economic at, say, 0.5 gram per ton or 0.7 grams per ton. And so now that 3 million ounce deposit goes to something like 5 million ounces. And that is why royalty companies historically have traded at such a premium to mining companies and attract such premium valuations, is because the good ones are delivering that time and time again for their shareholders and their investors.
So grade would be the amount of metal that's mixed into the rock. So for an example, you've got a mine that has, their main section here that has 1 million ounces in it, and they can produce that profitably at gold at 1,800 or above. They've got another area where there's less gold mixed into the metal that they might need gold to be at, $2,000 an ounce to be able to start mining that part profitably, because there's less metal mixed in, and so on. And so as the price goes up, they now have more and more metal to access at a profitable rate, which means, number one, they're producing more revenue. Even if the costs go up along the way, even if it requires more dilution of their investors, more borrowing costs in order to get their hands on that money, the revenue is going up. And so while that might not necessarily benefit the profitability of the mine or the investors, it still moves that top line up, which is a huge benefit for royalties.
Exactly.
So one other thing that I wanted to ask you about is kind of the long-term performance, because if you look at, there are periods of times hyper cyclical for some of these miners. If you look at something like GDX, you invest in 2013, it took years before you broke out of that channel, versus something like Franco-Nevada, obviously, is the biggest or most well-known example of this. It's just continually chugging along and moving higher and higher over time. And so tell me about that. Like, what's the reason for these long-term just movements slowly up?
Yeah, look, royalty companies, Joe, for the last 20 years have outperformed basically every commodity-based benchmark you compare them to. That's the mining companies, that's the ETFs, that's the physical, that's even the S&P 500. So for investors that are really looking for the right kind of commodity exposure, inflation protected, royalty companies have been that for over 20 years. And there's been some really highly successful companies in this sector that are very, very large. Someone like Franco-Nevada, that's a $30 billion plus company, Royal Gold, another US listed company that's in the royalties sector that's, I think, approaching $10 billion in market cap. So there's some very successful precedents. And then at the earlier stage, you have companies like Vox. We trade at 1x NAV or even a discount to net asset value that we expect to realize that type of re-rating or that type of appreciation relative value that some of these major companies have. So that's some of the differences. Is Vox is not trading at that premium valuation. In fact, we're trading at a discount to these peers and also able to find better value with our model of buying third-party royalties. So we have a nuanced capability that's systematic, repeatable of finding value. And then ultimately we hope and expect that we can trade at the same valuation range that some of these larger companies and comps in the market do.
Yeah, that makes a lot of sense. Well, in summary, inflation is hitting us hard. People are looking for a way to protect their money. And it looks like a lot of money is starting to shift into commodities, into miners, things like that. And as a result, companies that are positioned well to profit off of that, like royalty companies, could be a very important part of an investor's portfolio. And companies that have not yet gotten the attention, like Vox, I believe are absolutely important to take a look at for investors. I love your company, love what you guys are doing. Thank you so much for joining us today.
Thanks, Joe. Absolutely my privilege.
And I've got your website linked in the description below for anybody who wants to take a look at what Vox is doing. And as always, thank you guys so much for watching. Have a great day.